Hello, everybody. Good morning. Happy Saturday to everybody. Welcome. Raza Khan here from Qila Capital. Very excited that you could be here today. Today is a special one. We are doing what I call a masterclass on hotel investing. So I am just waiting. We're gonna wait about 3 minutes, let everybody trickle in, and I'm gonna put myself on mute. I'm very excited to share this fully stacked program with you today. We're gonna talk about the fundamentals of hotel investing. We're gonna talk about how to underwrite commercial deals, how to look at hotel deals particularly. And my hope and goal is that you walk away with a lot of value today. So thank you once again for joining us. I am going to start in exactly 2 minutes. I'm going to put myself on mute. Please hang tight. I'm going to kick it off in 2 minutes. Thank you very much, and I will see you soon. Okay, we are back. Excuse me. Thank you very much for joining us today. Raza Khan here from Qila Capital. There are a few friendly faces and a few strangers who I have not met before. So if this is your first time joining us, welcome. I'll do a quick introduction and I'll tell you what we're doing today. My name is Raza Khan. I am the Chief Investment Officer at Qila Capital, the co-founder and Chief Investment Officer at Qila Capital. My background is in a little bit of everything, asset management, finance, banking. I am very passionate about what I do, and I'm very excited to share with you everything today. So before we begin, if we can have a quick sound check, please. If you could just raise your hand and let me know that you can hear me. There's a little button at the bottom there where if you could just raise your hand, just so I know that you are able to hear me and everything is working okay. Okay, sweet. Perfect. Thank you. Thank you. Awesome. Very excited to share with you today. We do webinars once in a while, but the goal for today's webinar was to do something that lets people walk away with a little bit of value and understand how we look at deals. So you see how the sausage is made, so to speak, in behind the scenes. So what I'm going to do is I'm going to kick off. I'm going to share my screen. Okay. So are you able to see my screen? You can just let me know. Awesome. Sweet. Okay. So today's topic is we call it the Hotel Investing Masterclass. And the goal is to give you enough value that you can kind of walk away with knowing, and learning a little bit more about hotels than you knew before, and commercial real estate in particular. So before we begin, just a quick disclaimer, we are not your financial advisors. I am not a chartered accountant. Everything that I am talking about today is an opinion and it's strictly educational. Also, we are a company that operates under the 506(c) regulation of the Securities and Exchange Commission. Um, we are able to talk with accredited investors only. So I'm sure you've heard that before, but this is just to make our legal team happy. So what's our agenda? Our agenda is I will be making a presentation for about 50 minutes, give or take. And we're going to be talking about a few things. So we're going to talk about obviously the origin, how we got here. We're going to talk about commercial real estate, the wide spectrum of real estate, and how different deals are, in different sectors. The macro drivers, what separates a good deal from a bad deal. Then we're going to do a deep dive into the underwriting. Okay. This is not a really deep dive, but it's enough of a deep dive if you're a retail investor or an accredited investor and you want to know what happens behind the scenes. This should be good enough for you to really see what we see when we look at deals. And of course, then we're going to talk about towards the end, how to invest like the 1%. Everybody wants to know that. Towards the end, we'll leave a little Q&A section, 10 minutes, give or take. So this is typically we do a shorter webinar, but today's webinar may be a little bit longer. If you need to jump off, you can, but our goal is to give you a lot of value. Okay. And sometimes great things take time, as they say. All right. So once again, thank you very much for joining us. We're not going to talk too much about ourselves today. Quick introduction, Qila Capital, we are an asset management and private equity company based out of San Antonio, Texas. We only specialize in healthcare and hospitality sectors, okay? We're owners and operators in both spaces. We're not a typical real estate company. We're not developers. We're not land bankers. We're not doing any construction projects. We're only focusing on value add opportunities, particularly distressed properties where we're able to buy them for cheap, operate them correctly, and give maximum value to our investors. Okay. Let's talk about how we got here. Quick little, background on the history of wealth preservation. So we're not going to talk too much about this, a little boring, but it's good to know history, right? They say that those that do not learn from history are bound to repeat it. So that's what we're doing right now. So humans have always sought fortresses for wealth, or you could say, storage of wealth. We're not, we are animals, some would say, but since the hunter-gatherer days, what makes humans unique is obviously that we are able to trade services and goods, and anytime money is made, it is stored somewhere safe. Traditionally, people have looked at precious metals and they've looked at land. An interesting little tidbit, the word landlord comes from the term being a lord of a land, which originates from historical eras where land ownership equated nobility and social lordship, and the social status was based on how much land you owned. So real estate ownership has historically been a sign of upper strata of society, so to speak, okay? Let's look at you already know all this stuff. So let's look at the major events in human history. Okay. So this is important because it'll give you some context. All right. And I'll tell you how in a second. So in the 1630s, we had what was called tulip mania. I don't know if anyone has ever heard of the tulip mania. But as you may remember, there were a lot of trading companies, colonial trading companies, like the Dutch East India Company or the British East India Company, that essentially explored new lands and they found new opportunities. One of the opportunities they found was a flower in the Ottoman Empire, which is called the tulip. We all love the tulip. It's actually one of my favorite flowers. As a man, they say men don't like flowers, but I do. I like tulips for some reason. They're beautiful and they stay fresh for a long time. But in the 1630s, the tulip actually became the world's first speculative bubble. All right, in the Dutch Golden Age, okay, where basically there was a frenzy in the Netherlands that they have discovered this new flower, and all of a sudden, one of the princes of the royal family of the Netherlands, the House of Orange, showed his interest for tulips and how he liked tulips, and he started planting tulips in his garden. All of the public, they started going crazy. They thought, oh my God, this is the craziest thing, and it's going to go up in value. And the Dutch East India Company started issuing stocks, effectively what is today a stock. They issued a security for the future of the tulip plantation or the tulip growth, harvest. It happened for years. In 1637, it just collapsed because they realized it's not that special because they can grow. It's fairly easy to grow tulips. That was the first crash in human history. Okay, which is interesting to note. And then there were a lot of different financial events like the Mississippi bubble, the South Sea bubble, okay, where people in Europe were buying land ownership opportunities or securities in the New World, which is now America and Canada. And Mississippi, of course, was a big big land opportunity in the United States before the United States was a country. The Panic of 1809. Okay, this was one of the first times that there was a bank failure. Okay, it started out with the land speculation. Of course, we all know about the Wall Street crash of 1929. The Roaring Twenties led to crazy spending, and they call it the Gilded Era because people were spending money, they were splurging, they were partying, they were having a great time, right? With no real remorse for what would happen later. And then, of course, the party ended, and there was a huge correction in the Dow. 89% of the wealth was wiped out. And that's started what was called the Great Depression, as we all know. And the only reason why we came out of the Great Depression was the World War II, the Great War, which really, if it weren't for the war, I don't know what would happen. Another interesting event happened, which is the Bretton Woods Agreement in 1944, where the US dollar was pegged to 44 allied nations just to help them recover and rebuild after the war. Okay? And the idea was that the US dollar would be convertible to gold. Okay? But in 1971, Nixon changed that, and it basically became the US dollar lost its intrinsic value, and it became what's now called a petrodollar, right? There's no true value of the dollar anymore, except that it's the reserve currency of the world. And then we all know what happened in 2008. I don't want to talk about it too much. What happened in the pandemic. Definitely don't want to talk about the pandemic, okay? And of course, the banking crisis of 2023, which people don't realize happened because it happened so fast, but it did happen. A lot of few banks went under in 2023, okay? But the interesting thing to note, a lot of these events happen in our lifetime, okay? I wasn't around for the Nixon shock, but you'll see that a lot of these events are happening, sooner, and they're happening more frequently than they did before. Okay, let's talk about real estate now. That was just a little context of speculation versus real ownership. Let's talk about real estate now. So real estate, of course, we know that there's residential real estate and commercial real estate. We're not going to bore you with the details, but you obviously know that residential is anything that is up to 4 units, okay? Single family housing, anything up to 4 units, a duplex, triplex, or a quadplex is considered residential real estate. And then you get into commercial real estate, which is multifamily, anything over 4 units, which is the most well-known asset class in the country, okay? You have retail, such as plazas, shopping centers, shopping malls. You have restaurants. You have office, which even in office, there are multiple tiers, class A, class B, class C. And in the office space right now is one of the most distressed in the nation, as we've been hearing since COVID happened. People started working from home. Office became very distressed. Okay, then there's industrial. In industrial, there's light industrial, heavy industrial. The demand is rising, especially now with the retail being shifted towards a e-commerce model like Amazon. And of course, for Amazon, you need giant warehouses, you need cold storage, you need all kinds of giant industrial buildings. And now data centers is the new hot topic which people are talking about. And then there's hospitality, which we operate in, hotels, okay? And medical, like anytime you go to a doctor's office or you go to a hospital, that is considered medical real estate, okay? And then there's the hybrid model, as I call it, which are businesses disguised as real estate, okay? So hospitality really is a hybrid model because hotels are businesses. Hotels are franchise businesses. They're no different than a McDonald's or Burger King. When you buy a hotel, oftentimes, most of the times, you're getting the land and you're getting the brick and mortar building, but you're also getting the business. And the same thing goes for gas stations. When you buy a gas station, most gas stations don't make money off of gas. They actually make money off of the convenience store, the actual, Quickie Mart or whatever, the 7-Eleven store, for example. Convenience store, that's a big business. Same thing with car washes. Car washes are businesses. Same thing with laundromats. Okay. So obviously the difference between the two is that hybrid businesses or the hybrid real estate models, they are disguised as real estate, but they're operationally intensive real estate. Okay. But of course, there's an advantage to that. So this is a chart that I found on the internet. Of course, it's not as recent as it should be because it's up until 2022, but it shows you how the different asset classes have different yields. Okay. This is a very important metric, which we're going to talk about today, the cap rate, the capitalization rate. And if you look at different asset classes, you have hotels, you have residential, industrial, office, retail. You'll notice some of them have a low yield. Okay. This is the yield rate, the cap rate. And some of them have a high cap rate. What that effectively means is that if you were to spend X amount of dollars, let's say $100,000, you will get more money, more return on your money if you were in an operationally intensive business like a hotel versus residential, like single family or multifamily. Of course, that's fair, right? Because businesses, they require management, they require staffing people, human resources. It requires purchasing materials on time, everything from toilet paper to soap to towels, linens, all that stuff. But in single family or multifamily housing and residential, you don't have to deal with that because you sign a lease with your tenant. The tenant takes over. They're in there for a long time. No problems. God bless you. Okay. Of course, in 2020, during COVID, the hospitality sector took a dip across the nation because travel tanked during COVID. But generally, it performs better than other asset classes. Okay. And of course, office also tanked, as you can see. It did okay. But during COVID, there was a slight dip, not a lot, but a slight dip. Okay. So what's the difference between passive and active? I just talked about it. So passive is the type of real estate that is completely stress-free. You are effectively buying something and you are watching your money grow from the sidelines. You're not, the most you'll have to do is deal with property management headaches. Of course, it requires a little bit of management, but not as much management as an active business like a car wash, gas station, or real estate or hospitality, for which you need managers. You need general managers, you need assistant managers, you need sales and marketing staff, you need cleaning staff, front desk, shuttle drivers, et cetera, et cetera. Active business. Okay. So what's the trade-off? The trade-off is that in active real estate, you have more discretion. If you're good at management and you're good at operations and you're good at operating a business, you have more things in your control. You're able to turn things around, okay? Which means you are able to get a higher cash flow. And there's a direct relationship between a cash flow of an asset and the value of the asset, which we'll talk about in a moment. Okay? Let's talk about the macro drivers. Let's talk about the anatomy of a good deal. So what's a good deal versus a bad deal? Okay? Of course, they say location, location, location. You're probably tired of hearing that, but it's true. Location matters. The more people there are in that area, or the more people there are moving to that area or traveling to that area, the more in demand your property will be. Okay? Demand drivers. What is a demand driver? It means some sort of an economic driver in the area that forces people to use your property or forces people to use your service or product, whatever it is. In this case, we're talking about real estate, so your property. Okay. For example, if there is a new plant, a new Toyota plant or a Ford plant that is announced in an area, or a new Amazon warehouse, or a new data center that's being announced in an area, the likelihood that the value of that land going up is high because more people are going to want to live close to the plant. People are working, they need to get to work, etc. Okay. In the hospitality business, it's slightly different. Airports are great demand drivers. Okay. Airport properties are usually more expensive than other properties that are in the boonies, like far away in the sticks. Okay. A property that's right off the highway, a hotel that's right off the highway is going to be more in demand because people are driving on the highway, they're tired, they want to rest for the night, they see a hotel room, okay, boom, demand driver. Same thing with a college campus or a military base. These are the demand drivers that we look for, and you should also look for if you want to do a deal by yourself. And that's our goal today, to teach you everything you need to know. If you want to do your own deal, no problem, go for it. So the geography trends, that's the other thing. So generally the southern states, the Sun Belt does better than the other states for obvious reasons. The weather is a big one. Politically, they are very different. The southern states are politically a lot more different than the blue states. And we're not talking about red versus blue, Republicans versus Democrats. We're not talking about politics, okay? But it's a fact that some states have less jobs and less growth than other states. Generally, the South is booming right now. Okay. So it makes sense to invest in the South. And in the South, there are some states that are better than others. Texas and Florida are fantastic, for example. Okay. Market conditions, very important. So there is an inverse relationship between interest rates and cap rates. Interest rates, meaning the Fed rate, like anytime the Federal Reserve, the central bank announces a cut or an increase in rate, you know that is going to affect the market. And we'll talk about that in a moment. So effectively, the interest rate is the cost of borrowing money. In our Western capitalist societies, like the United Kingdom, Canada, United States, all these countries, there is a direct relationship between the cost of borrowing money, the amount of liquidity available in the economy, the amount of money that's available floating around in the economy, and the cheaper the interest rate, the lower the Federal Reserve rate, the Fed rate, the more money is floating around in the economy. And when there's more money, people are able to use that money, invest it, borrow it, use it for starting a business, use it to buy real estate. And when those things happen, all the drivers go up, like jobs, the number of jobs that are being created go up. But also other things go up, like inflation, which is not a good thing. And when inflation goes up, things get too expensive. The cost of food gets too expensive, clothes, everything. And that's what happened during COVID. During COVID, because there was a big crash, the Fed did not know what to do. The immediate response they have is, hey, let's lower the interest rates because whatever jobs we may lose because of the pandemic or people staying at home and people not traveling, they're stuck at home. Let's lower the interest rates so people can borrow money and they can invest money and they can offset the loss, the economic loss in the economy. And of course, when that happened, the inflation went up, things got expensive. You may remember during COVID, real estate got expensive all of a sudden, like 30%, 20%. The cars got expensive all of a sudden. Not only did cars get expensive because of the semiconductor chip shortage, but also because people could upgrade cars all of a sudden. The loan rates went from 6, 7% to 3, 4%. So people said, hey, why don't I just upgrade my car? Why don't I buy a new car? It's so cheap right now. My monthly payment is going to be low. And when that happened, the demand went up. Okay, I don't want to repeat myself, but you know what happened during COVID. So there's a direct relationship between interest rates and cap rates. We'll talk about cap rates in a moment. Okay, let's talk about what are some of the main definitions and terms in the world of commercial real estate. Okay, I'm just going to check really quickly to make sure everyone can hear me and see me. Sounds good. Lovely, lovely. Thank you. Okay. Everybody can hear me okay? So let's talk about the main definitions and terms in the world of commercial real estate. If you talked to me before, you may have heard me tossing around these terms like cap rate or NOI, net operating income. And I realize that for some people that are not in this industry, they may not understand what I mean. So that's why I'm doing this to show you guys. I'm going to break down all of these in a second. Cash on cash return, loan to value or loan to cost, occupancy rates, vacancy rates, market value, replacement cost. Okay. So at this time, I'm going to switch over to my other screen, which is a handy dandy pen tool. Okay. In every balance sheet, and if you can just raise your hands to see, to let me know if you can see this. Can you see this scribbly drawing that I'm doing right now? If you can please let me know if you can see. Awesome. Thank you. Thank you so much. All right. In every business or in every any real estate or business, there are some things, right? Money comes in, which is your revenue. Okay? Revenue is the money that comes in. In hotels or sorry, in multifamily, this is rent. In office, it's rent. If you own any rental properties, this is your rental income. If you operate a business, this is the amount of money you get from selling something. If you sell steak knives, for example, this is the money you get from selling steak knives. And then, of course, you have your expenses. Okay? In every business, your revenue minus your expenses is your profit. And now there are different terms for that for profit. Let me just lower the weight here. Okay. So there are different terms for this. So in corporate in the corporate world, it is also called your EBITDA. Okay, earnings before interest, taxes, depreciation, and amortization. So before your loan payments, before your taxes, all that stuff. This is your net profit. In the world of commercial real estate, this is called your net operating income, NOI. Okay, very important. And as we talked about it first a second ago, okay, I'm just gonna erase that. Okay, so in the world of commercial real estate, this is your NOI. So your NOI is your revenue minus your expenses. Okay, in commercial real estate, it is your revenue minus your net operating expenses, as they call it. Rev minus operating expenses. Your net operating income, NOI. The NOI is your profit, like I said, okay? What is a cap rate? People talk about cap rates all the time. Your cap rate is your NOI divided by the value, price, or value. Okay? So this is your cap rate. It's effectively your profit rate, for lack of better terms, or lack of better words. So, for example, you bought a property for $1 million. Okay? Your net operating income is $100,000. So your net operating income divided by your purchase price or the market value, whatever it's worth, is 1 million. That means your cap rate is 10%. This is your cap rate. Now, because we all learn math and algebra, we can see if we move these numbers around, we can determine different things. For example, if I have the cap rate of a property and I have the net operating income of the property, I can determine the value of the property. So the cap rate is used for multiple things. It's used as a valuation tool to determine how much something is worth. It's used as a yield tool. Okay, so how much is it a property going to generate? So I can determine a few things with this formula. Very simple, and this is not a math lesson, guys. We'll move on to the presentation in a second. We can use it to determine how much something is worth. We can use the cap rate to determine how much something should generate or how much will it generate, and how much you're buying it for and how much you'll be able to sell it for. This is the most important thing. This is how we use it in hotels, in the world of hospitality and commercial real estate. Okay, like capital uplift or profit, basically like how much we can sell something for. Okay, now let's reverse this. I hope everybody got that. Very simple. So what are the implications of the cap rate? Very important, okay? You want high cap rates in a property. You want to buy at a high cap rate, or you want to turn it into a high cap rate, and then you want to sell it at a low cap rate. Because what do I mean by that? If the cap rate is, if you bought it at a $1 million, if you bought something at $100,000 NOI and you turned it into 120,000 NOI, let's say you bought a piece of real estate. Let's say you bought a multifamily apartment and it was generating 100,000 in profit in NOI a year. And because you're smart and you're good at operating, all of a sudden you raise the rents. You were able to take it to $120,000 cap rate, or sorry, $120,000 NOI. So let's say you bought it at 100K NOI, same cap rate valuation, let's say 10%. So you bought it for $1 million. Okay. And if you took it to 120K, the NOI, you have now converted it into a $1.2 million property, because there's a direct correlation in commercial real estate between the value of the property and the income it generates, because people will pay more for something that generates more money because investors are looking for a yield, right? So this is the high level summary of, we're not going too deep into this, into one metric in particular. So I talked about the NOI, which is your EBITDA also, your revenue minus your expenses. Then we talk about the cap rate, which is your net operating income divided by the price or value. Okay. And one more thing to note is the cap rate is also used as a market indicator. So for example, there's a direct relationship between the cap rate and the Fed rate, as I talked about earlier. If the Fed rate is high, like right now, we're in an economy where the overnight rate is high, almost 7%. The Fed rate, or the it's also called a prime rate. So if the prime rate is high, that means the the cap rates are also usually high, meaning that properties are making the same amount of money, but people are willing to pay less for the properties just because it's too expensive for them to buy, because cost of borrowing is high. So if you buy something and all you do is you just hold it and you sit through the turbulent times, when the interest rate comes down, when the Fed rate comes down, the amount of money that people are willing to pay goes up. The demand goes up for the property, which means the cap rate compresses. So direct relationship between the cap rate and the Fed rate. Then you have the cash on cash return. When you are buying something, you're not just like, let's say you bought something for $1 million. You're not putting $1 million out of your pocket. You're usually putting 20% down and you get the rest from the bank, right? Down payment, and the other 80% is debt. So if you increase the value of the property to 1.2 million, that $200,000 profit, once you pay the bank back, that $200,000 profit goes to your bank account, right? Because it's profit that you generated. So the actual yield, the increase, it's even though it's 20% here, you increase the value of the property by 20%, but on your money, you increased it 100% because you put down $200,000, right, to buy this property. So that means you doubled it. You basically double your 200,000, which is 100. It's 100%. It's 100% cash on cash return, as we call it. 100% cash on cash return. Okay. Let's go back to this. I don't want to spend too much time. I know I'm eating up a lot of time. Thank you for your patience. Okay. And then in the world of commercial real estate, you have other metrics like occupancy rate and vacancy rate. Occupancy rate is how much of your property is occupied throughout the year, or how much of it is leased out. And vacancy is how much of it is empty. And then you have the market value and the replacement cost. Market value is how much is someone willing to pay for the property. Replacement cost is how much would it cost today? If you were to build it today, how much would it cost? And right now, as we all know, the cost of construction is really high for obvious reasons, which are obviously the tariffs. Materials are really expensive. Although the timber comes from Canada, the aluminum comes from Canada, and steel. And when we put tariffs on it, the people here, the producers, have to pay more money. The cost of materials go up. Same thing with the labor cost. With all the ICE raids that are happening around the nation, people are getting kicked out, people are getting deported. Obviously, not all construction people or construction workers are illegal or undocumented, I should say. Even though they may be documented. The amount of the amount of the labor market has pressures on it. So because less workers are available, the cost of labor goes up. Okay, let's talk about actually how to analyze a good commercial real estate deal. Okay, and we're talking about hospitality. So these are some of the terms that are only found in the world of hospitality. You have your occupancy rate because in occupancy, like in a multifamily versus hospitality, we're looking at occupancy rate as an average of the day by the day, basically, right? So you're factoring in 365 days of the year, not just monthly occupancy rate. Okay, so it becomes more prominent. Then you have the average daily rate, the ADR, which is the average amount of income generated per occupied room. Then you have the RevPAR, the revenue per available room. This is the industry standard for performance. The RevPAR is how much revenue is available per room based on the number of rooms that you have in the property. Then you have total RevPAR, which is all the ancillary revenue streams. For example, in the world of hospitality, in hotels, we don't just make money from the rooms. We make money from the breakfast. We make money from the bar. We make money from parking sometimes, laundry sometimes, right? So there are different revenue streams in the world of hospitality, and that is what this is, TRevPAR. And then you have the average length of stay. How often are people staying, and what's the duration, the average duration of stay? Okay. Extended stay hotels, for example, they have more people staying in for a longer period of time, like traveling nurses or professionals that are in town for business. They need amenities that reflect that. For example, they want access to food. They may even want a little kitchenette in the bath in the room. They want a good gym in the room, which is important. And then you have MPI, Market Penetration Index, which shows you how a hotel is performing against its immediate competitors. Okay? I think I repeated this slide. I apologize. Okay, let's talk about how to find a good deal. So look at good fundamentals. Number one, what are the fundamentals which we talked about? Location, demand drivers, okay, a good cap rate. You want to buy at a good cap rate. You don't want to overpay for something, right? The higher the cap rate, the sweeter the deal that you're getting. Okay. And by default, hotels sell at a higher cap rate because they require more operational know-how. Like you need to be able to manage a business. It takes time, it takes effort, energy. Okay. And of course, you want good brands like Marriott or Hilton or IHG. There are other hotel brands like Choice Hotels or Wyndham, and they're good, but they don't attract the type of traveler that is loyal to the Marriott brand, for example, which I'm sure a lot of you are. Marriott Bonvoy. What are some of the places that you can look? What are some of the sites that you can look at? So there's Crexi, there's LoopNet, there's auction sites. What we're going to do is we're going to look at you can look at this. These are on market deals. The Crexi and LoopNet. These are commercial real estate listing sites like how you have the MLS. So these are the commercial real estate MLS sites, Crexi, LoopNet. But when you're on it, you're competing with everybody else in the market and everyone's looking for a deal. The best way to get a deal is off market. Sometimes, distressed sellers. Sometimes, when something is going into foreclosure, the bank is taking over or the bank has taken over and they're auctioning it off. Those are the best deals. And those are deals we look for because we don't want to compete against everybody else. Okay. Because then you end up paying more. You don't get a sweet deal. Okay. So anyway, underwriting a hotel. We're gonna walk through a hotel balance sheet together in a moment. Okay. So let's do that now. I am going to open a pitch deck and I'm going to show you. So this is an actual example of the hotel that we are buying right now. And you may have heard about it. You may have seen it in our marketing materials, which is the Aloft Hotel at the San Antonio Airport. Okay, 1 second. Let's see if I can. One moment. I'm just transferring this to my other screen. So this is the San Antonio Airport, and this is literally the pitch deck that we received from the sellers. Okay, 141 rooms, built in 2009, 5 floors. Okay, it's got these amenities. It's got the XYZ bar, the refuel breakfast area, outdoor pool, fitness center, etc., etc. Okay. So again, right off the bat, they're telling us that we're selling this way below replacement cost in a high growth market. Okay. Performance upside post PIP. So this property needs a PIP, property improvement plan, which is in the world of hospitality. Every few years, you have to upgrade the property just to modernize it, new furniture, new carpets, new signage. Sometimes they make you change the tiles, new mattresses, all those things, new TVs. So of course, when you upgrade, when you spend money into something, because it requires time and effort and energy, there's a reward for that. And the value goes up of the property because you're able to charge more money per room. Okay. Your average daily rate goes up once you complete the PIP. Okay. So let's just go into the numbers. Here we go. So this is a breakdown of the competition. So it's showing us how the property compares for the fiscal years 24, 23, 22 against the competition, the comp set and the subject property. So as we can see, in 2022, the occupancy was 68%, slightly higher than the competition. In 2023, it was slightly lower than the competition, and then it went up again in 2024. It was above competition again. So you can imagine why, because people are probably traveling more. This is an airport property. Post-COVID, people started traveling again. The demand for travel rose in general. Okay, and then of course you have the ADR, the average daily rate. It shows you how much the property generated an average daily rate and versus the competition. So it was slightly under the competition in 22 and around the same in 23 and 24. And then you have the RevPAR, the revenue per available room, which is a very important metric, a performance metric of the property. It shows you that we have a higher ADR in 2024 than the competition. And then you have the slightly lower, and then it kind of ranges, up and down. But it all depends on the operations. Like the world of hospitality is very dynamic, guys, because every day there's a whole team dedicated, excuse me, there's a whole team dedicated to selling the hotel at a more competitively. For example, the room rate goes up and down. There are corporate rates that are being allocated to groups. Like if an airline wants to book 10 rooms for their pilots and their staff, the cabin crew, then they get a special rate. So there's a whole team dedicated to measuring the performance of a hotel. Okay, let's look at the historical financial statement. Now, like we talked about the NOI, net operating income. In the world of hotels, it's a little bit more complex because the expenses are broken up into departmental and non-departmental expenses. Okay. You have your revenue coming in. So as you can see in 2019, 2021, 2022, 23, 24. These are the metrics they've provided us, the sellers. And by the way, this statement is from last year, okay? Because we heard about the property during the summer. We tied it up. We realized we wanted to buy it. We're about to close on it any day. Next week, we're projecting to close. I've been seeing emails back and forth from the title company. So these are the numbers. This is what the total revenue was in 2019, 4 million. Then all of a sudden it dropped significantly, and we know why it dropped. COVID, obviously. So it went from 4 million in 2019, and then they completely skipped 2020 because it was probably a really bad year, obviously. 2021, the revenue was 3.2 million. Then it went up again in 2022, 4 million. Then it dropped again in 23 and then 24. And the reason why is because this property is not operated the way it should be. And that's why we're buying it. Okay. So that's what the numbers tell. The numbers always tell a story. Okay. So you can see the revenue is broken up. It's coming from the rooms, food and beverage, which is a significant, 250,000 on average every year coming from food and beverage. Other expenses, other departments may include like laundry, for example, parking, for example, like if the parking lot is big enough and someone else wants to use it, some people want to book it, or I don't think this hotel does not charge the guests, but in any case. And then expenses. So the expenses are broken up by department, and then you have some expenses that cover the whole hotel. For example, room expenses, that includes laundry, that includes the cleaning staff, housekeeping, things like that. Okay. Food and beverage, food coming in and being sold at a profit. As you can see, the food came in, it cost 166,000 and it sold for 280. It generated 284,000 in revenue. So it generated some profit, obviously. It should be. Total departmental expenses are right here. 922,000. Let's look at 2024 just to have a benchmark. So $1.4 million, which is a little high, as you can see, very high, if you ask me. Then you have your undistributed expenses, which includes internet. It includes your franchise fees, which are paid to Marriott every year. They don't care. They want their money. They want to get paid. That's why they let you have the flag. Sales and marketing, repairs and maintenance, administrative in general, that includes the staff. Okay, so the gross operating profit is right here. And then you have your fixed expenses like insurance, taxes, management fees, etc. Now, this property is, how do I get rid of this? Okay, here we go. Just going to zoom out slightly. The net operating income is right there at the bottom. I don't know if you guys can see it. It says EBITDA and then it says net operating income. So this hotel is only generating, according to their numbers, 427,000 in net operating income, which is terrible. Okay, but that is where the opportunity lies. Because we know the complete story that this hotel was distressed. The seller was over leveraged. The seller is some institutional group. They have a lot of hotels. They weren't managing the hotel properly. It became distressed. It went back to the bank. The bank hired a management company. They spent way too much money operating this property in different ways. And because we have other hotels, we know how much it should cost. And we have an independent management company that gave us a pro forma. And according to our research, it should not cost more than $2.5 million to operate. According to our management company, it should not cost more than $2.7 million to operate. 2.5 and 2.7. Sorry, I may have said 1.5. 2.5 and 2.7 million. The NOI should be a lot higher than it actually is in this property. And that's why they're giving us a pro forma, as you can see here. They realize the hotel has not being operated correctly. So they're telling us, hey, Mr. Buyer, if you buy the hotel correctly and you run it correctly, in year 1, 2, 3, 4, 5, these are the numbers that it should be doing. The revenue right here, about 4.5 million, goes up slightly every year. In year 5, it's about $5 million, 5.1 million in revenue. And your total net operating income should at least be 1.1 million to $1.4 million. Like, this is very conservative. We are very confident that it's going to do a lot better than that because we have other properties that perform way better than this, including the Staybridge Hotel, which you may have seen. Actually, you know what? Why don't I make it interesting? Why don't I just open it really quickly? Total income. Okay, I don't know why it's doing that. Total income. Sorry about that. Here we go. Total income revenue. Where is it? Where is it? Where is it? Where is it? Income right here, miscellaneous income. Total income is $6.7 million. Okay. And total expenses, if we go down, 2.188. So it's less than 2.2 million for the expenses. The net operating income is $4,517,000. So you see how we're operating a hotel that generates more revenue, significantly more revenue than the sellers of the Aloft. And we are only spending $2.2 million. They were spending $3.5 million, $3.6 million, which is insane. They're burning money and it's not being ran correctly. And folks, that is the difference between a good operator and a bad operator. Okay. Let's get back to the presentation now. Now, I'm going to share with you a very simple metric. I learned this from hotel operators like that have a lot of hotels. They don't do what we're doing. Like we're looking through all the sheets right now, the financial statements, but the big operators don't look at that. What do they look at? The revenue multiple. Very simple. They ask a bunch of questions. How much is the hotel generating? Okay, they ask the following questions. How many rooms? Location? Brand? Okay, and then revenue. All they care about is the revenue because they know it's going to cost a certain amount of money operating it. As long as the revenue is there, that means that the people are coming to the hotel and that's what matters. People are transacting. That's what matters, right? So anything between a 3x to a 5x multiple is considered decent. The lower the multiple, the better the deal. Okay. So this is a little napkin secret. The Aloft Hotel at the airport, the one that we just went over, this hotel did $4,135,000 in revenue. And how much did we spend? How much are we spending to buy this hotel? We are spending the purchase price is 10.5 million, which is incredible. We're getting a really sweet deal. And we're also we had to do a $2.5 million PIP, a property improvement plan. But even with the PIP, $13 million in total. So I'm just doing my calculator really quickly for everybody. So it is a 3x multiple, effectively, which is considered really good. The lower the multiple, the better the deal. Okay. Another couple of very interesting napkin math, a simple napkin math that you can do. And I'm just going to type it out here. Replacement cost and average market value. Average market value is very simple. You look at what similar hotels or similar properties are selling for in the area. And of course, if you're getting a really good deal, they say the money is made on the buy, not the sell. Okay. Replacement cost right now is about $200,000 a key per door or key, as we call it in the world of hotels. So by that definition, I'm just going to move this up a little bit. So by that definition, this hotel, the Aloft Hotel that we looked at, is 141 rooms. So 141 rooms times 200,000 is $28.2 million. Okay. So are we getting a good deal if we're buying this hotel for 10.5 million and we're spending another $2.5 million on PIP? I think we are. It's a hell of a deal, actually, if you ask me, because it's going to be worth more. If we were to build this brand new, it would cost us $28 million. And in the hotel business, it doesn't matter. I mean, as long as the property is not too old, if it's 30, 40 years old, then yes, it matters because there's going to be structural issues. But this hotel was built in 2009. So that tells us it's a hell of a deal because it's going to bring in a similar amount of revenue per room, right? The RevPAR that we talked about, revenue per available room, is not going to be that much off versus brand new hotel. Okay, let's move on now. Okay, how to invest like the 1%. The 1% of investors, the smartest investors in the world, the most successful people in the world have some things that they do. They have some habits that they do. They like to stay in their lane. If they are physicians, they like to practice and they like to do what they're good at. They don't venture outside into a risky territory. They have a conservative strategy, conservative mindset. Okay. So, and they look for the best of both worlds. They look for profits like active and the lack of headache like passive. So, like in passive income, in passive real estate, you still have to deal with property management. You still have to, if something breaks down, the tenant still calls you, right? They don't try to be an expert in everything. They partner with people who have years in the industry. They have industry experience. And the art of operating, let's talk about this. The value isn't just found, it's extracted through management, market positioning, and geographical timing. Okay. And that's why we launched our fund, the Qila Capital Fund, the Hotel Cash Flow Fund, because we wanted to give investors an opportunity to invest in active deals while having no responsibilities. So it's strictly passive. You get cash flow, okay? You earn more and you live better. You also enjoy some of the lifestyle benefits. So this is not a part of the presentation. I'm not going to waste time talking about ourselves because it's not the best thing to do. But I'll send you this deck and you can review it after. Who we are, we have about $110 million in assets under management. We specialize in the South Texas region. We're masters of this domain and we don't like to venture outside this geography. This is a part of, remember we talked about location and demand drivers. This is a corridor that is underserved. There's a lot of demand and not enough people servicing that demand. Okay, because it's a difficult area to operate. You have to speak Spanish, for example. When you go to Laredo and McAllen, it feels like Mexico. It does not feel like you're in the US, especially Laredo. It doesn't even look like you're in the US. The streets look different. The shops look different, which is quite fascinating to me. It feels like you're in Cancun, actually, parts of Cancun. These are some of the brands in our portfolio. We have Marriott properties, we have an IHG property, we have one property that's being converted into a Hyatt Studios, one of the first ones in the US. This is our own brand. It's called Optimal. It's a wellness and recovery spa, which is being expanded to multiple markets now. It's a franchise opportunity. And then we have our healthcare portfolio, which consists of Laredo Emergency Room and McAllen Emergency Room. This is what the hotel portfolio looks like. This is the Staybridge Hotel, which I showed you momentarily. This is the all-star winner of our property, of our portfolio. It does exceptionally well. Over 95% average occupancy because we have military contracts. We have a contract with the Union Pacific Railway Company because in Laredo there's a big it's a big trade hub, right? You have a lot of trade, a lot of products coming from Mexico in the railway. So their employees, they prefer to stay at our property because our properties are ran impeccably well. We have the Aloft Hotel at UTSA, University of Texas in San Antonio. Remember we talked about the demand driver? That's a demand driver in this property that is located in the best area in San Antonio, and it's located a mile away from the college campus, and it's the best property in that vicinity. And they just recently announced that they're launching I believe it's called a D League. I'm not a sports person, but NCAA in the college basketball, they have a junior league, and they're bringing a basketball team to this campus, which is going to be incredible for us and our investors because this property is actually in the portfolio. And people are going to be staying at our property, parents, athletes, all that stuff. We have a courtyard. This one's located next to the Lackland Air Base in San Antonio, which is a major military installation. It's one of the major hubs of the US Air Force. A lot of training, basic training, and all that stuff happens here. We have the extended stay hotel, which is being converted into a Hyatt Studios. And then we have the Aloft Airport, which is being closed on next week. So we're excited about that. Okay. These are some of the assets that we have in our healthcare portfolio. We have the Laredo Emergency Room, which performs exceptionally well. There's a private equity company that just made us an offer less than 10 days ago for $84 million, which is a lot of money, right? A year ago, there were a couple of private equity companies that were willing to pay less than 50 million. Now, one company has offered us $84 million because we're very good at operating. Like the number of patients that come to this ER, very high compared to the competition. McAllen Emergency Room. This one is not fully stabilized like this one, but it's on its way up. It's growing very aggressively, which is great. Micro Hospital in Brownsville. This is a plan, a conceptual plan, which we're planning to build on. And we're actually going to be launching a healthcare fund, excuse me, this year. And we're going to be bringing one of these opportunities to our investors that you can invest in. And healthcare performs a lot better than hospitality. It's a little bit riskier because of the anything can happen with the Trump presidency, right? Like if the RFK Jr., if they decide to change the insurance companies or whatever, this business depends heavily on the insurance reimbursements. And then we have a few other healthcare related businesses or practices. We have a hospice company, end of life care. We have a medical equipment company, and then we have Optimal, which I talked about. What makes us unique? We're not going to talk too much about this. We focus on South Texas, cash flow first. We only look at deals that cash flow right away, and deals that are demand driven next to the demand drivers. And we have a proven track record. Two of our hotels have an average occupancy of over 95%, which is unheard of in the world of hospitality. And that's what we hope to do with all our properties. We look at 10 deals, we like one, we pick one out of 10. That's really the ratio. Okay. This is a way that you can get involved if you like the story and you like what we're doing. We have a hotel cash flow fund right now. We listen to our investors. We've talked to dozens of people from across the nation, and we took everybody's feedback and we created the perfect product. It's a portfolio of 3 hotels. 2 of them are Marriott's, the Alofts. One of them is a Staybridge. It's anchored by the Staybridge, which is a property that does over $4.5 million in net operating income. Okay. We're raising about $20 million throughout the year. And we're going to be deploying it over these 3 hotels. 2 of them we already own. One of them we're about to buy next week. The second Aloft, the one at UTSA, we closed on 3 months ago. So it's a new acquisition. It's still on its way up. And our goal is that we're going to stabilize the 2 Alofts and pay and anchor the income of the tenant with the Staybridge, which we already have, which does over $4.5 million in NOI. Okay. Total value of the entire portfolio currently is $56 million. Total equity in the portfolio is $39 million. So it's very de-risked and very, very conservative in terms of underwriting. This is what the investment summary looks like. If you're an investor and you're an accredited investor, you want to invest up to $500,000, you get an 8% fixed distribution, plus you get an annual uplift bonus of up to 5%. And this is paid out at the end of the year. So your average IRR that we're targeting is about 13% a year. The whole term that we're targeting is 3 years. So we have 5 years in the paperwork. It's a 3 to 5 year range, but we are very confident that we're going to give everybody their money back at the end of year 3. So we're targeting a 3-year hold, not a 5-year hold. Even though because we are a 506c fund, we are required to have an exit timeline in the deal. And the best part is our investors get access to the MMP discount at Marriott. If you're a frequent traveler, imagine if you can invest in an opportunity that gives you amazing returns and you get to travel the world and live a better life. And that was really our goal with this. We wanted to give our investors access to amazing lifestyle benefits, and that's how we came up with this idea of giving them actual discounts that we get as investors in Marriott properties. There are over 10,000 hotels around the world that you can utilize this discount in, and it's uncapped. Use it as much as you like, and that's how things are done. This is the structure of the fund. You're investing money in a fund, and the fund is then allocating money to a lower tier entity. Okay. This is what the discounts look like. These are all the hotels that you could utilize your MMP discount at. Okay. There are all these different brands under the Marriott Bonvoy umbrella. You have the premium brands like the Ritz-Carlton, St. Regis, the W, the JW Marriott. You have premium brands like Marriott, Sheraton, Westin, etc. Meridian, Renaissance, which is very nice. I really like this Renaissance brand because they take historic properties and they turn them around. And then you have the select service brands. This is what we operate because the select service brands are actually way more profitable than these brands. Okay. As a matter of fact, I was talking to someone who is an employee at Marriott corporate, and he was telling me a story. This is literally happened 2 or 3 days ago. He was telling me a story of how he had lunch with the CEO of Marriott, and he made a very funny comment. And he said, if you want to impress your girlfriend, buy a premium property. But if you want to make money, buy a select service property. That's what the CEO of Marriott said to this individual that I was talking to 2 or 3 days ago. Okay. The select service properties perform better than the premium properties because there's less to do. There's no restaurants and you're not, hiring all this waiting staff and kitchen staff and all that stuff. They're more no frills. You make more money per room or per square foot in a select service hotel than you do in other properties. This is what the discount looks like in case you haven't seen it before with the MMP rate. This is an example of a lovely property in Laguna Niguel, California. Almost $1,200 a night. After the discount, $281 a night. Okay. This is all real, folks. You can search it up and we can even provide you real examples. If you want to see, if you're planning a vacation this year and you want to see what that discount will look like, please reach out to me and I'd be happy to show you. And some other examples. This is one of our current investors who just took a trip in Switzerland, and he took a trip to Saint Martin. That was his first trip as an investor. He got the MMP discount. Then he went to Switzerland. I forgot the name of the city, but I think it's here. I think this is the property right here. $1,400 a night with the discount. It was $363 a night. So in 1 week alone, the amount of money he saved, he got 50% on his money just in the discounts alone in one trip. Okay. So this is a summary of if you're interested in investing with us, this is a summary. You have to be an accredited investor to invest with us. Okay. All our investments are self-directed. We have a lovely portal that you can use. And in the portal, you can review the documents. All the reporting is done there. I invite everybody to get on a one-on-one call with me to discuss how we can help you. And this basically is the end of my presentation. So what I will do is I will drop my calendar link in the email, or sorry, in this chat. And at this time, I will open the floor to questions. So please don't be shy. First of all, thank you so much for being here with me. And I can see everybody that was here in the beginning, they're still here. So thank you. That means it was a good presentation. People not dropping out. I hope I did okay. I hope I gave you some value. That was my goal. Our goal for this webinar is not to sell you anything. We're not salespeople. I'm the co-founder of this company. And I'm very passionate about what I do. And I want people to take away value and apply some of these things to their decision making. So you have money, you work really hard for your nest egg, and then you need to deploy that nest egg very responsibly. So this will hopefully help you with the decision making if you are looking at any funds or any fund manager right now, whether it's multifamily, hospitality, whatever, or if you want to buy your own deal. We're not going to hold any secrets. If you want any advice on if you want to buy your own hotel, please reach out to me. No problem. But I hope you got value. Okay. Let's open up the floor to the questions now. Okay. Please let me know what questions you have. Thank you for your patience. Thank you for being here. I know we ran a little bit over the time allotted. We're pretty much done the presentation at this time. Let me know what questions come to mind and I'd be happy to answer them. Do we have any questions? Please don't be shy. Thank you. Thank you. Thank you for your comment. We have a question. We have a question. Do you see any downturns in the next 2 years in South Texas? So, um, I don't believe so. This is my opinion. I'm not an economist. I'm just a student, and I follow the trends. I think that South Texas is booming. Texas as a whole is booming significantly, and it's booming for multiple reasons. So people are moving from California, people are moving from all different states to Texas, and naturally it creates a ripple effect. People start moving out of the cores. They get priced out of Austin. They move to other places like San Antonio. San Antonio, for example, on average, has a new 100 residents moving in every day. 100 new residents are moving to Bexar County, which is the greater San Antonio area every day. San Antonio is undergoing a $2.5 billion airport expansion at the moment. Okay. Which means that this is a Mickey Mouse airport. I don't know if anyone's ever been to San Antonio. We have a very tiny little airport. I wish it was bigger. It's one of those airports where you drop off in one place and then the terminal, you just walk over to it's just one building, two terminals. But they're building a brand new purpose-built terminal, $2.5 billion expansion. The airlines have already been notified that like there's so much demand for people to come here, but not enough airlines cannot find enough available routes. So to answer your question, Texas is booming. South Texas is booming significantly because there is a huge emphasis on the southern border now. And I think even after Trump leaves, there's going to be an emphasis on the southern border. So you got all these federal agencies that are moving there. You have the National Guard, you have the border services people, and they have two different types of border agents. They have the ones in the blue shirts and they have the ones in the green shirts. And people realize that there's a lot of trade happening, and it's one of the hidden pockets of Texas. Texas is the best state to be, and South Texas, in my opinion, is a hidden gem. People always flock to Dallas, they flock to Houston or Austin. South Texas is where the opportunity lies because there's a lot of demand and not enough people servicing that demand. Hope I answered your question. I don't see any downturn. I think it's going to continue growing very I wouldn't say aggressively, like it's not a boom or bust market, but it'll continue growing steadily. Okay. Second question, can you invest IRA money? Yes, you can. The flexibility of the 506c fund it's the ultimate flexibility. You can invest as an IRA, you can invest as a trust, an LLC, or as an individual. The administration recently announced certain changes in the one big beautiful bill, which came out, as you know, a lot of tax implications have been changed and whatnot. One of the things that the one big beautiful bill has is wider access to investments for 401k holders. So it is now hypothetically, we haven't done it yet because it's brand new. It's a new law and it has not been rolled out like in practice yet. But even with your 401k, there is a way to invest in 506c funds. Hope I answered your question. It's very simple. You need a self-directed IRA account with your custodian. If you're with one of the big guys, like one of the big custodians, like Equity Trust Company or Inspira Financial or the Directed Trust Company, there are so many of them. You just need a self-directed IRA account with a custodian that allows you to do private placements. And Fidelity does not do that, by the way, because Fidelity forces you to buy their products, which are mediocre and they have management fees. Guys, one of the things I forgot to mention, we have no fees of any kind in our fund, okay? This is one of the ways we wanted to give value to our investors. We have no fees of any kind, okay? No acquisition fees, no management fees, no asset management fees, administration fees, accounting fees, nothing. Our investors get a pure partnership model. You get paid. We make money on the back end later on when the value of the hotel goes up. So we're giving most of the cash flow to our investors to the fund. Okay. Next question. How do you go about finding off-market deals? Is it mainly through relationships or do you have a methodology for it? Great question. We find off-market deals in multiple ways. We scrape the internet all the time for auctions. Sometimes you get lucky and something pops up that is worth it. And once an auction pops up, they just give you, they don't put a price on it. They just give you the deal document. They give you, sorry, they give you the deal room, which allows you to look at the numbers. So using the numbers that I showed you right now for the Aloft Hotel, for example, we look at the balance sheet, we look at the financial, the P&L, the profit and loss statement. We do our own due diligence and we determine, hey, do we want this property or not? And then we dig around a little bit more. We may go visit the property. We may go visit the area. We look at Google Earth. Like that's something I do. Not everybody does. I go on Google Earth. That's the first thing I do. And I zoom in and I see what the area is like. And to answer your question, we scrape the internet. We are subscribed to all the auction listings. And a lot of times, what happens is if a lender takes over a property, if a property goes into receivership, the people find out about it, right? And then they start whispering. When they're whispering, they start calling people that have the ability to close. Because we have a lot of liquidity from our healthcare portfolio, we generate almost 15 million, more than $15 million a year in cash flow just from the healthcare portfolio alone. Because we have liquidity, they call us and they say, hey, there's a property that may be coming up for sale. I don't know if you're interested. Do you want more information? So we usually find out. Sometimes we find out from our friends and industry contacts. Like we have other hotel owner buddies that find out, they say, hey, there's a beautiful hotel that's coming up for sale. It may be too big for us. Are you interested? Yes. Okay, send us more information. Sometimes we get a deal directly from the seller. So right now we're looking at a full service property, which I'm not going to tell you what it is because it's not locked up yet. We don't have any concrete paperwork yet. So if I announce it, just to give you an idea, full service brands are Marriott, Sheraton, Westin, Meridian, Renaissance. So it's one of those brands. It's located in a major metro area in Texas. And we know the owners, and the owners are not breaking even because they're over leveraged. Like their bank financing has gone up. They have other properties. They're very motivated to sell. So if this deal happens, we may be able to buy it completely off market, not even through an intermediary. We're just gonna come up with a fair price, go back and forth, get lawyers involved, and close the deal. So that happens sometimes. Hope I answered your question. Another question. What is your company's solution to tight entry-level labor, housekeepers, custodial, breakfast service, etc.? Our solution is that you cut cost where you can, but in some areas you don't cut cost. So luckily in Texas, where we are in South Texas, the labor market is not as bad as other cities or other states, like New York, for example. We still have good labor here. But we believe in paying people, like especially the front staff, the front facing staff, for example. We believe that we should pay them a fair wage because they are the ones that create a good guest experience. So we pay them well. Like if the industry standard for a front desk person is $18 an hour, we would like to pay them $20 an hour because if they're happy, we know that's gonna emanate to the guests. Like if someone's smiling because they're happy at their job, they don't have to worry about putting food on the table, they're going to do a better job. So to answer your question, we cut costs wherever we can, but the labor, we find good labor because we pay them. We take care of people, and there are areas where you should cut cost, and there are areas that you should not cut cost. And I think that's the staff, you should not cut cost. Uh, but we do our own hiring. We do a good job. We work with a good management company. So these premium branded properties, we have to work with a management company approved by Marriott because Marriott is very, very strict about how their hotels are operated. They don't want their hotels to be operated mom and pop style like some of the lower brands like Wyndham and Choice Hotels, etc. I'm sure you've gone to a small town, a Motel 6 or Holiday Inn or Express or whatever, and you see people, you can tell their family, like one guy's here and then another person's in cleaning rooms upstairs. Marriott does not allow that. So we work with a very good management company, try to give as many incentives as possible to the staff so they're able to stay, create a good work environment for them, so they feel like a part of a family and just take care of people and take care of the guests. There are a lot of things that we do that other hotel operators don't do. One example I like to give people, and I don't have it with me right now, I wish I did, but every one of our properties that you check into, when you go to a normal select service hotel, when you check in, maybe you'll get a water bottle, plastic water bottle. And you know that water bottle has been sitting in a truck or in a storeroom for 3 weeks, leaking microplastics. No offense to anybody that drinks bottled water. I don't drink bottled water for that reason. But maybe you'll get a water bottle if you're lucky, if it's a good property. Sometimes you get a cookie. And some of the Hilton properties, I know you get a cookie and you get two water bottles in a little bag, right? At our properties, what we do is we buy aluminum water bottles from China. We buy 10,000 of them, okay? Not 10,000, 3,000 of them. And we get 10,000 and then we tell them like give us 2,000 for this with this brand, 2,000 with this brand, etc. Beautiful reusable aluminum water bottle that they can take through TSA, okay? And it's a really good bottle because I use it myself. And like you use it for a month, 6 weeks, and you throw it away because it gets dinged and but it lasts like 6 weeks easily. And on every floor of our hotels, we have a reverse osmosis filtered water machine where you can go and you refill your water bottle. So that little thing, it's a very basic human need. Clean drinking water is a basic human need. You should not have to drink tap water at a hotel because it doesn't cost that much more to operate a reverse osmosis water machine. Okay. So these are some little things that we do to create a good guest experience. Even though you did not ask that question, but I thought I'd let you know anyway. So that is it. Are there any other questions? If you have other questions, please let me know. If not, we can end the call. And I'm just being mindful of everybody else's time. Uh, I am here. I'm here to talk. One thing I will do is I'm going to drop a link to my calendar. I just dropped it in the chat. You can also email me, and we'll send you a follow-up email after the call with the pitch deck and the recording of the webinar and my calendar link. If you want to speak to me directly, please don't be shy. I love talking to people, and I love my job, and I love my favorite part is talking to people and hearing everybody's stories and just talking, and it's fun. So if you have any questions, please reach out to me directly, one-on-one call, and we'd be happy to do something with you or give you advice if you want to do your own thing and if you're looking at some other deals, you want to compare how this compares with other deals, we're happy to look at that. So thank you very much one more time. I hope you got some value from this webinar. And this time it's been an hour and a half. So this is the longest one I've done ever. So usually I don't ramble on this much, but thank you so much for joining us today. And we hope you have a lovely weekend. Enjoy the rest of your Saturday. And we will reach out via email very soon. Thank you. Thank you. Thank you once again. Goodbye.